people need a roof over their head. So there's going to be security in the multi space, so I think there'll be more. I don't know if that means, does that drive cap rates lower in multi because there's so much more capital chasing deals? I don't know, but I do think there'll be more capital looking for the sort of the security that multi provides.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else. With your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How you doing?
I'm good. Got an awesome guest. We got the better half of one of our early guests, actually our original premiere episode. So I think we're gonna have a good time. I think it's gonna be a fun podcast. We'll see where it goes. And other than that, just another day, another dollar.
Yeah, absolutely. People don't want to hear us anyway. So let's dive right in. Let's get our guest on. So Andrew, thank you so much for coming on.
Yeah, thanks for having me, guys. Looking forward to it.
Awesome. So let's kick things off. Give everybody listening some context, who you are, where you're from, a little bit about, kind of your story and your come up and what you do.
Sure. Well, Andrew Campbell, one of the co-founders of Wildhorn Capital. You mentioned you'd had my business partner, Reed Goosens, on an earlier show. The two of us are Wildhorn Capital, and we are I'm based in Austin, Texas, was born and raised here, and we're focused on kind of value add multifamily in Central Texas. So really focused on Austin and San Antonio. Got a portfolio of about a little over 1,800 units. Been active in that the last probably 4 or 5 years. I guess my background, I grew up in Austin, and I actually went to UT and got an advertising degree. Bounced around the country. We were talking before we started about how hot it is here. Spent about 5 years in Minneapolis. I moved back to Austin in 2007. My dad had a stroke, and so I flew home, and I basically never left. Kind of helped him rehab, and that kind of threw me into real estate. I ended up quitting my job and selling my house, and kind of threw me for a loop. I was 27 at the time. So kind of reevaluating, what did I want out of life, and figuring out a way to create a little bit more ownership of my time, so I could help take care of him some. And so that kind of launched me into looking for passive income and into real estate. Started with duplexes and fourplexes. Built up portfolio, about 75 of those. And a lot of that was, just dumb luck. I was buying stuff in Austin in like 2009, 10, and 11, where it would literally, some of it would double in 12 months, and I'd pull the equity out and go do it again. And I think as I scaled that and kind of learned the business and was managing everything myself, just realized that number one, I really enjoyed the business, and you can see kind of the returns and the flexibility it could create, just the relationships you get to build with, your tenants, and you kind of, you see it's not that difficult of a business, but also realized I couldn't scale, 4 units, 8 units at a time, that the bigger properties were really a lot more efficient. So that's kind of what got me into the larger multifamily space, looking at those types of deals, and from there kind of ran into Reed, and we've been hitting it hard since.
Love it. So how did you and Reed get hooked up?
We actually met at a conference. I guess I was looking to make the transition and look at the larger deals. He had done a couple of deals with some different partners. We just kind of met and then kept in touch after the conference, and kind of was talking some about underwriting and deals, and I think pretty quickly realized that in each other it was a guy that was hustling as hard as I was, and had complementary skill sets. Over the course of a few months, he was looking in some different markets, including Central Texas, and I was focused really here. I said, well, let's partner up, and you've got his background structural engineering and done some ground up multi, and my background's marketing and advertising, and I'm kind of local, kind of good equity relationships. So we kind of, divided and conquered, and just realized it was, we took it like a dating relationship, date for a couple deals, and you decide to get engaged and you decide to get married. But it was just, met sort of networking and not necessarily looking for a partner at the time.
Love it. I think it's so important. I think we hear time and time again, similar stories or echoes of the same stories of, people just meeting each other through different connections, and, working on a couple things, kind of part-time or as one-offs until, you find out you work well together. So, I love to hear that. It's pretty similar to how I met John, a little bit differently, and how I started working at Toro, but be that as it may. So you guys own 1,800 units. Have you guys bought and sold anything, or that's everything, you guys hold for the long term?
Yeah, we kind of, mid to long-term holders, 5, 7, we got a 10-year deal, 10 plus year deal with a partner. We actually got an opportunity zone deal under contract right now. That's a
Nice.
10 plus year play. So, I think probably a little bit longer hold than the average, syndicator or kind of private equity group looking for a 3-year flip. And maybe some of that's, my background of, hey, I got into this space. I was looking for super long-term buy and hold, forever. And I think that still kind of drives our thinking a lot. And I think some of the market we're in, just, hey, Austin and San Antonio, Central Texas are growing so fast. You can hit, good solid doubles and get in and out, but there's just such value on the long term that that's kind of driving some of the thesis as well.
I think that's an interesting take on it, right? Because you're right. A lot of the private equity syndicator sponsors, it's buy, value add, in, out, get out. I think one of the biggest challenges from a little bit of a longer term outlook, I think there are two things. One, harder to do in tertiary, maybe not as growing areas. So I think that you guys have that behind you. And I think, the 800-pound gorilla in the room, and I'll ask the question because we have the same problem. We talk about this all the time. How does a sponsor, or how does someone in your shoes and Reed's shoes, how do you guys make the money you want to make while still delivering the right product when a lot of these deals are structured with hurdles and prefs and upside driven results? What keeps you guys disciplined to say, yeah, we just got a good offer, or yeah, we could probably sell this and make a hurdle, but I think 7 years is a better deal, or 5 years from now is a better opportunity? Because I think that's the thing that I think you guys do really well. And I think it's a missing piece in a lot of sponsors' businesses.
Yeah, I think real estate is not get rich quick. It's get rich slow. And so I think we've got that mindset. We've got a long-term mindset to how we're building our business, and the idea, hey, we can do this for the next 30 years. I turned 40 next week. I intend to do this forever. It's fun. So we're not in a hurry to kind of get in and get out of the business or of the deals. I think, being kind of disciplined a little bit and saying, hey, this is what we're setting up for, being pretty clear about this is a deal in this area. We think it's a 7 to 10 year play or a 10 plus year play. And then just kind of holding to that as far as kind of making money, we're thinking long-term. So we're not trying to get in, get out and try to make a bunch of money on the front end for us. We've got asset management fees, kind of keeps the lights on. And we look at we're planting seeds, every time we buy a deal. I joke, we bought this deal last year. It's going to be at least a 10-year hold. We kind of got a one partner, sort of a 1031 JV type deal. And I joke, that's one of my kids' college accounts. I've got a 6-month hold. It could be that kid's college account. Mm-hmm. I don't really worry too much about the exit and kind of when does that happen? Just don't force it. And again, I think a lot of that's the confidence of, we know we're in a really good market that, everybody is growing, is going to be there. And it's the upside is there, today. It's certainly going to be there tomorrow.
I think it's a good spin on it, right? Because we differ from most is, yes, you make money as the deal performs, but we put a lot of our own capital into our deals. So, I think in every one of our deals, if you look at it, we're 20, 30, 40, if not 50, 60% of the capital sometimes. So it's a little different where we're not just waiting, we're waiting for our money to make money. And then you're also getting the asset management fees, which, like you said, they just keep the lights on. It doesn't, you're not going to get rich quick. And I think if you're getting into real estate to get rich quick, you're in the wrong business, especially given that, where the market is today and the last 10 years is what's happened. Can you speak to, a little bit of a longer term hold, what the capital, the intent, what's the capital intensiveness, if that even makes sense, behind, owning a deal a little bit longer term? Because a lot of people going with a, relatively lean budget to, maximize upside as quick as possible. But, if you own a deal for 10 years, you have more HVAC replacements, especially in an area like Austin, Texas, where it's hot or, in those areas. Can you speak to how you guys may look at a deal a little different and say, okay, if we're going to go a little bit longer, we're going to have to bring more money in? Or is there a capital, preservation plan day one put in place for the longevity?
Yeah, I think it starts with the type of deal you're looking at, the type of asset. And one of our So our focus is, we're the two things we're really clear about. And when we go buy a deal, it's got to be core MSA Austin or San Antonio. So we're not looking too far outside of that and kind of tertiary or outskirts. It needs to be part of the MSA, and it needs to be kind of Class B or better. And we really kind of stick to that, where we're not, if it's a rough C deal, I mean, we've written articles about this. That's sort of the common value add, right? If you're looking for that 3-year plan, buy a C class deal and then convert it into a B class. I think that number one, that's really, really hard to do right now. At the end of this 10-year cycle, every C class deal has been bought and tried to convert into a B. So if there's anything left, it's probably really, really a C class and maybe a D. That's going to be a really rough deal. And you can hit a home run on that, but it's a lot of risk. You can get caught with your pants down, your bridge loans come due, pandemic hits, you don't hit your value add. I think that adds a lot of risk, and we're not willing to kind of take that risk. So it starts with, we are really looking at, B class better deals. So going in, you got a pretty good idea of it's what you're buying, and you kind of set your capital aside for that. And so we're not coming into buying a deal that's 50% occupied and have to put, 50% down as far as our renovation budget. Our typical renovation budget is maybe 10% of the purchase price, maybe. We want to take something that's pretty good and make it a little bit better. Again, goes back to that longer term mentality and kind of what our goals are. I mean, I tell our investors all the time, we're getting to know people, said, hey, you're not going to see the highest marketed returns from us. Let's be clear. Like I'm not ashamed of that. We're looking at everything on a risk adjusted basis. We've got somewhat of a unique point of view and a thesis that we really believe in. I'm not a 10 or 12% IRR and a super solid market is a really good deal. And there's not as much risk. So we can underwrite for that. And then, longer term, there's going to be HVAC replacements. You have capital reserves, lender reserves that you can tap into for that stuff. But then you also account for it. I think typically we say 25% of the AC units on any given deal, we're going to replace in the first 2 years, no matter what. If we get into DD and it looks worse, we may have to up that some, but it's part of what we underwrite too. And you kind of take that longer term, let's maybe take a little bit longer view of upfront the work we need to go do on some of the exteriors or some of the things that are deferred and spend the money because we know we're going to bear the fruit of that, 5 years from now, 7 years from now.
So I love that because, we've bought some very heavy lifting, very rough deals. And yes, there's risk associated with, and knock on wood, the market's been very good to us. So I have no complaints. But, one of the best deals that I've ever invested in personally was not a syndicated deal. It was our own property, and it was it's a 2003 built deal. There's not a stitch of headaches whatsoever. Is it the 50, 20, 30, 6x multiplier? No, it's not. But there's something to be said about peace of mind where when you go to the office, you're not worrying about we had our Monday morning call the other day and my partner was like, it just seems like every day, there's a fire, there's a shooting, there's a murder. It seems like that happens more there. You guys probably, it happens everywhere, but it's probably less headache driven and more, we're buying really good piece of dirt. And I say it all the time. I can show you a 30 on paper, but there's something to be said about a 12. And I think that is something that most people don't want to own. And I think everybody wants to put on paper a huge return. I think you guys are doing it really good. And it's awesome to see, because, Reed and I, when we met, similar times and, it's awesome to see that model does work if done properly. So I give you guys a ton of credit.
Yeah. Well, I think it's about, you got to know your market. I think you got to be true to what you are as an operator. I think I walk on to some C-class deals and I'm like, I'm not comfortable here. And there's a risk, and I think that was one of the things when we started raising money out from outside folks is just, you've got to take the responsibility as the operator. And, if you're going to go deliver a 30, there's a good chance you're going to swing and miss and it might be a 0. I think we've kind of taken a more conservative approach. Baseball analogy, my job, I want to go hit singles and maybe stretch those into doubles. We're not swinging for the fences.
I love that.
So how does that conversation go with investors? Because I know a lot of times we get beat back on two things. One, the time frame. So many people that get in contact with us are, I would say the majority are looking for those short-term flips. And a lot of times they are looking for more risk with more upside, and they really only care about the numbers you put on paper in the back of the book. They don't look at location. They just don't look at that stuff hard enough. Some people do, and then some people have the weirdest sticking points ever. Do you just have those conversations with the people that are looking for that you don't even try? Or is there a conversation you have where you can kind of massage your message and people start to understand?
But I think from a sort of marketing standpoint, that's kind of, what my background was. I mean, number one, we're very consistent with our message, so every time I'm on a podcast, we talk to anybody. I mean, look, it's Central Texas, it's B+ and better. It's good, solid stability, risk-adjusted returns. And then that message goes out, if people are coming into us, like they've seen that message. So there's no misconception about kind of who we are and what our focal point is. So we don't get a ton of pushback and say, that's not enough, that's not high enough. And if we do have that conversation, that's fine. Like there's different types of investors for different types of deals. We make introductions to people all the time, to other operators in other parts of the country, or have different, models. So it's not a big, we don't get a ton of pushback on it. I think frankly, people, and I'll ask a question as on a sort of get to know you call with an investor. So look, if I could give you a 10% return in Austin, in a really good location, or you could look at a 20% return in a, Amarillo, pick on a tertiary market, not a ton of population growth. Like, you tell me, what would you rather have? And most of the people that I'm on the phone with will say, I'll take the 10 in Austin. And that may be kind of self-selecting because it's sort of an inbound marketing funnel, but we don't get a ton of pushback because I think we're like, that's who we are. I mean, Wildhorn delivers 12% returns in Austin and San Antonio. We're not trying to do anything else. And on a longer term, that longer horizon, I think, is another factor of that, where there's decent cash on cash and there's security and safety here. You're buying in a market you believe in that
Mm-hmm.
Everybody's talking about. And I think that's a huge part of what we're building and kind of, I'm super lucky to be born and raised in Austin. If I was from like Pittsburgh or something, I don't know if I'd be as excited and be banging that drum as loudly. Like, I'm really lucky to be here. It's growing like crazy. It's number one on all these lists, and that doesn't seem to be stopping. So let's leverage that. And as the market evolves, we'll continue to kind of be opportunistic and find good opportunities here. But there's an inherent sort of security by being local and being in a market that has the fundamentals that we do have.
So I think that's key, right? And probably one of the biggest reasons for success, born, raised, lived in one of the greatest areas, because we get the not pushback, but, we live in New York, right? We're 30 minutes outside of Manhattan, which has just exploded. We can't buy what we want because, it's extremely difficult. And not that we can't, it's not what. There's a lot of risk associated with the deals today at a 3 cap or a 2 cap or a 4 cap, right? And it's just, leverage is tough or whatever. And we get investors ask us all the time, like, why Jacksonville? Why these areas? And we give them the answer like that. And they say, well, where, if I want to invest somewhere, where do I go? And, I tell people, look in your backyard. There's nothing wrong with not investing in your backyard. But if you happen to be in a great area where you've seen, felt, and lived it, that's awesome. I mean, that's great. I think the one question I have, piggybacking off that, being that you are local and then you have the experience managing, you guys use third party. Have you thought about vertically integrating that because you've done it before, or because you've done it before, you don't want to do it?
I mean, it's a constant debate. I don't want to do it, and I think Reed's a little bit more inclined to do it. And some of that's just kind of our personal interests and skill sets. He's a little bit more operationally focused. I think right now it's not the highest and best use of our time. And, it's a really, really hard business. And it's, a lot of HR and a lot of payroll and the people management. And that's not something I'm really good at. Not something that I enjoy. It's part of the reason we've built this business to be small. We are very clear. We're not trying to build a 50-person company with an office floor. I don't want to manage people. So I think that's a part of that, and kind of recognizing, like, what do you enjoy? What are you good at? And kind of building the business to support that. But I think there's really good third-party management companies. And still, I do think being local allows us to manage those groups, a little bit more tightly, and can pop by and talk to them, and, kind of you're sort of in the same spaces. So But it's not, at least today, it's not a big focus. It's something we talk about. I kind of joke with him. I was like, man, go nuts. You got my support if you want to build one out.
And the thing is, I know, he's out in California. So if it was built out, it'd be built out in your backyard. So you're probably it would be a lot more, yes, he might have his hands in it and make it go, but it's in your backyard. Do you get more from your management because they know you're local, whereas out of state, for us, if I tell my manager we're going, the properties always look good. If we just show up, they look good because we have good management. But do you think you can, you guys get a little bit more attention or you keep tighter reins on it because they know you're in their backyard?
Maybe, I think we've got a good relationship with them and we're able to yin and yang a little bit. Certainly when he's in town, everybody kind of knows he's in town, is prepared for, and I have more of the drop bys and, hey, just checking in. And so they're a little bit maybe on their toes. But I think a lot of that in selecting the management company is really important. We picked a company out of the chute that was a swing and a miss, and that they didn't have the scale. But I was worried that we'd go get a big company, we wouldn't be important. If you got a massive, we're not big enough to get attention. I think as we had a little bit of scale and we made a transition, we get good service. Number one, they're a good management company, but number two, they know we're growing. We're kind of active on the acquisition side. They're helpful on that front, and so they're incentivized to kind of help us grow the portfolio. But I think there's a piece of a local, they're headquartered in Austin, so there's certainly a local aspect that's probably beneficial. I always talk, I tip my cap to guys like you that do it out of state. I couldn't do it. I tell you, I don't know how you do it. Like not being in your backyard, it's difficult. And we tried it. A couple of years ago, we got to have a geographic diversity for our investors. Let's go to Atlanta. And I went out to Atlanta a ton, and we looked and chased a couple deals, got kind of close, and just realized it's too hard, and maybe back to because we were in such a good market here at home. Like, I think what I learned in that exercise was every market's super competitive. So cap rates weren't any better. Returns didn't look any better. All was equivalent. Good, same thesis, B plus better assets, good locations. Like, it was all the same, but we didn't have any competitive advantage. And that distance was just made it incrementally more difficult than it was to just be here with, hey, I don't have to get on a plane. I know these markets like the back of my hand. I know the players. I know that we've got all the systems built. So I think we kind of pivoted and said, rather than offer geographic diversity and try to cover a bunch of markets, like, we're laser focused. And that's kind of part of the message still, is like, Central Texas, born and raised, that's where you focus, period.
Yep. No, I think that makes sense. And that's probably a quote unquote competitive advantage to a degree, right? You're a local. So I think when an investor's speaking to you, you probably, whether you do it or not on purpose or subliminally, but they know investment, you guys, it's your backyard. And you're right. Because, when you're doing it out of state, there's a level of trust you just have to give up. And even if you're doing it in state, there's someone that's running the day to day, but it's a lot closer to home. So, that's probably something that, if it's apples to apples and you have to travel 2-3 hours to get there, what's the point? So I think that's, it's good to know that. And you guys went through the exercise and realized, hey, we might not have diversification geographically, but we do this really well. And this is our mission. So that's, very defined and awesome.
Yeah.
Yeah. I think too many people that I've spoken to look to invest out of state because it's become almost like a popular term. If you're in New York and LA and you want to invest out of state or out of the area, I get it. But I know people that live in Texas, Florida, Tennessee, and they're looking in different locations because they can't, quote unquote, find a deal. And to me, that's always just been mind blowing. I've never really understood why that would be the case. And I think too often people use it as an excuse of, oh, my market's not good enough, so I can't find something. I'm going to go somewhere else. I think there has to be a larger emphasis on investing in your backyard, investing in your area, if it's the type of deals you're looking for. Like you said, the difference between Central Texas, Florida markets, Atlanta, markets in the Carolinas, there's only so much differences between them. Maybe there's some demand drivers, things like that. But if you live in Atlanta, yeah, maybe you would prefer a slightly different demand driver, a slightly different demographic. I think the benefit of being in your backyard probably outweighs some of the benefits of being in the other market that's maybe slightly more what you're looking for. The only difference I could see is if you were looking for, something that just cash flowed significantly better. So if you went to, a smaller Midwest state or up north or market, or you wanted a, top 5 MSA like New York, if that's what you were looking for. Otherwise, I think there's too great of an emphasis placed on out of state with a lot of people. Cool. So when you guys are looking at deals now with the pandemic and everything going on, has anything changed for you guys? Are you guys just kind of in a wait and see mode? Or do you think there's going to be some fundamental changes going forward?
We've certainly updated our underwriting criteria and kind of, backed off rent growth, added in some concessions, kind of our general thought is, and you guys, you got to put a stake in the ground somewhere. It's going to, we think it'll take maybe 2 or 3 years, to kind of get back to where we were, so Austin's been growing, 5, 6, 7% rent growth in places at times. Certainly back that off. And so we're going to get no rent growth this year, maybe a little bit next year. So changing some of the underwriting criteria, adding in some concessions for the next year, burning those off sort of next year. But I think we're not changing kind of the thesis, again, like B class areas, B class assets. There's still people moving here. I think one of the things we're talking about a lot is it certainly the pipeline, initially slowed down a ton, stopped just like everywhere else. There's been a few deals that have been out and about and kind of floated and have come our way where I think it did help to be local. It said, hey, we're kind of showing these to a few local groups. Travel wasn't an issue, all that sort of stuff where that has helped. But I think, as you look at and you see the anecdotal stories as well as sort of just some of the data showing, how this may accelerate, a lot of what was already happening with the inflow of population, the migration from the coast, people fleeing the Northeast. Is that going to accelerate, and are people going to move here at even quicker? I think we don't know, obviously, but I think there's a hypothesis that perhaps the population is going to grow even faster than it was, and that you look at I think as a market, multifamily, we fared very well compared to most of the other asset classes. I think multi and industrial have done the best. Offices struggled, retail's gotten killed, hospitality's dead. So multi looks really good right now. And then I think Central Texas and Austin and San Antonio's collections have done really well relative to a lot of the other markets. So if you stack both of those up, it feels like there's going to be a lot of competition, maybe even more capital trying to get into these cities. And if there's population, like it could make it even more competitive. So I think we're trying to be, we use the word opportunistic a lot, and kind of, hey, can we find something that we feel like works with some adjusted underwriting criteria? But is it in a good location that we believe in over the long haul? Still kind of is the driver.
I think that's good. Have you guys seen, for us, we've seen a big gulf in the last 3-4 months of buyer and seller expectations. Have you seen the same thing in Texas?
I don't know that it's big. There definitely was an initial gap. If you look at, there's a couple things that floated in kind of April, middle of March, like right as the hysteria was really settling in, and everybody was worried about what the collections were going to be in April, and May is going to be worse than April. And turns out, May was better than April, and we've been, 96, 97, 98% collections in our portfolio anyway. It seemed like there was a gap of people were wanting sort of a 10% discount, and sellers were willing to say, maybe 5. I think a lot of that too was the debt market was just frozen. You didn't have any idea how you were going to get funding for this, and maybe you could get a Freddie loan, but you had all these extra reserves. As that's thawed out a little bit and opened up some, it seems like deals are starting to move. I got a call yesterday on a deal that said, hey, I thought you had a couple weeks, but you need to get an offer in, this week if you're going to play. It feels like stuff's starting to move, and I think a lot of that is that the debt market's thawing out a little bit. But again, there hasn't been a huge dip yet anyway. Collections have been just pretty damn good, 97, 98%. So I don't know if it's buyers that are going to, bridge that gap and come back up, and maybe they get a 5% discount, or maybe there's no discount, but it does seem like there's more activity, as each day goes by.
Do you have any thoughts on, there's some articles and people talking about how there's all this dry powder on the sidelines. There's all this money being raised from institutional spaces for distressed opportunities. But there's also a lot of businesses and other sectors that have been hurt. Do you think there's going to be, and best guess, less the same or more capital looking for multifamily coming out of this because of all the different factors coming into it?
I think there'll be more. I mean, I think, we were just kind of talking, it could be more competitive. And I think that's kind of one of our hypotheses, that groups that, number one, everybody paused, so everybody's lost a quarter of the year, and you got money to put out, Q3, Q4 could be really active. If you've been focused on other asset classes and you see sort of the security that multifamily provides, and sort of, if there's this massive shift in the way people are working in office spaces and companies need, 50% less office space or whatever the case is, people need a roof over their head. So there's going to be security in the multi space, so I think there'll be more. I don't know if that means, does that drive cap rates lower in multi because there's so much more capital chasing deals? I don't know, but I do think there'll be more capital looking for the sort of the security that multi provides. Then I think the other piece of that is the risk of inflation, and as much money as we've printed and everybody's talking about, that's that kind of the next big concern. And if there's another round of stimulus, how much inflation there is? Well, the best hedge against inflation is a hard asset. So, buying real estate is going to be appealing.
Yeah, I think that's hugely important. I'm curious too, because when you were talking about cap rates and compression, one of the things we've spoken a lot about is, the end of last year and into the beginning of this year, we saw the treasuries come down and interest rates went way down. In Florida, cap rates went super low. I mean, we were seeing things in Orlando and Tampa going down into like the 4% range, like low 4% range, for stable value add properties. I don't know what cap rates were before that kind of happened, but did you guys see a same thing where as interest rates went down, cap rates also fell, and then all of a sudden the pandemic hit and it just kind of froze? Or did it stay kind of stable through that period?
No, I think we saw something very similar. In Austin, you definitely were seeing, 4.25 was not. 4.25 was probably about market for a value add deal. I think don't know if it went down tremendously as interest rates came down, but there's always a correlation between where interest rates are and cap rates. And I think people talk about, hey, cap rates were. I used to buy this at a 6. Well, interest rates were 5. Well, now interest rates are 4. As long as there's a spread there, if interest rates are 9 and cap rates are 8, there's still a spread. So I think there's a correlation. And I don't know if interest rates are going to 0. A lot of people think they are. I think that the 10 years kind of stabilized some here in the last week or so. But as long as there's a spread, I think people will continue to be buying these deals, and the cap rate, it gets a ton of focus. I think in some ways it's a little bit arbitrary. It's kind of just a measure of what people are willing to pay. And are you looking at the cap rate you're buying on the T12? You're looking at what your year 1 is, or, in our case, we're kind of looking at what's it look like in year 3 or 4, given that we're trying to, be a longer midterm holder.
Mm-hmm. So I think one of the things that I think about, and I have no idea, and I'm curious if you guys think about this at all too, or have any thoughts, with cap rates being, at one of the lowest points ever, if not one of the lowest points, and you guys are buying deals for 5, 7, 10 years in time frame, do you worry that if now coming out of a recession, which they just called it, that things normalize and then they start with the interest rate hikes again, like we saw, a year and a half, 2 years ago, and that cap rates start to come back up and it affects values in 5, 7, 10 years? Or do you think, interest rates have just been falling for so long, we're just kind of in a sort of new norm and they're never going to go significantly higher?
I don't know. I mean, I think underwriting wise, we certainly are expecting rates, cap rates to be higher on an exit, and kind of built in some measure of every year, for every year of hold, there's another increase in cap rates. I don't think anybody knows, and right now, like the amount of money and stimulus that we're printing, what's the long-term effect on that? And, how many people are going to be wanting to buy the hard assets as inflation hedges? Can the economy sustain rates? I mean, most of the rest of the world's in negative interest rates and has been for a while. I don't know. I'm not smart enough to know what happens there and kind of what the implications are. I don't see interest rates going sky high. That's for sure. I think it sort of maybe they're a little low, but I mean, I've got several friends that are, in the financial space that say they're going to zero, or say that, 2% is the new norm. So I don't know.
No, I agree. I mean, I just asked.
But you guys don't know where cap rates are going? I'll tell you exactly where I'll tell you exactly where interest rates are going.
No, but I think it's important to at least think about, because so many people just throw a blanket. Like you said, most people should be underwriting to a higher cap rate than what they bought it for, what the market is in however many years. But people just throw a blanket number on it, like, oh, we'll raise it 5 basis points every year or 10 basis points every year. And I mean, you have to choose something, but sometimes I worry that people are just throwing it on because it's socially acceptable. And I'm just curious how other people are thinking about it. Because, if there is that relationship, which we've seen, since 2009 to today, where interest rates were, 6, 7, 8%, cap rates were the same, and they've just continued to both come down. What happens if it goes the other direction? How does that affect things? So, I don't think anybody knows, but I don't think people are asking that
question enough, though, because you asked it, and I was going to say that, you go hold a deal for 7 to 10 years, right? If nobody knows what's going to happen in 2, 3, 4, 5. The longer you go, you're right. The socially acceptable thing to do is raise the cap rate. But if interest rates, over the next 36 months go to 0 or go to 2 or go to 1, well, what the socially acceptable person, is that the new norm? And now anyone out here, and all three of us and anyone listening to this, if you put an investment book together and you go pitch someone that cap rates are going down, you're going to be that lonely sheep that's walking that way and the herd's going this way, and nobody's going to probably give you money unless unless you have some super complex hypothesis behind it. But you're right. I don't think people are bucking the trend or even asking the question, because it's just, hey, this is how you're taught to do it, right? Do this, do this, do this. And, I'm not nearly smart enough. I'm barely smart enough to get out of bed and walk down the stairs without falling. So nobody knows, but that's the thing. It's like, there's so much money that was just printed and just given to people. And if there is another round, interest rates can't go up, because it would just be massive default across the world. You can't just raise interest rates tomorrow. I have my economics background is worthless, but there is a level of you just can't like push a button and raise it, right? So who knows? And that's the part that, there's when you buy a really good piece of dirt in a really good growing market, the fundamentals behind it, that is not where I would be focused my intention on investing or I got to make sure this works at a 50 basis point increase, right? I would be looking at, okay, look at my physical asset, look what it is, look at the competition. I want to own that property. I don't think people invest and or buy things with that mentality more often. And I think they're always worried about what the numbers say and what the books say, good, bad, or indifferent. I feel that way. I feel that there is a level of look what I'm buying, and do I like it or not? Do I want to be in it for 10 years? And I think, that's a piece of underwriting that goes maybe under the wayside, because there's no, equal IRR formula in Excel that answers that question.
Well, I think that's the fun part of real estate. And we talk about it in the sense of the art and the science, and I think it's really easy to wrap around the axle on the science and beat up a spreadsheet and build in your IRRs and your cap rates and rent growth and, all these assumptions. You start tweaking one little knob and all of a sudden it's a good deal. But what is the art? And I think that's a place where, another place that kind of Reed and I connected early on. It's like, well, he's an engineer and I'm an ad guy. Like I am the art and he is the science. And we kind of can marry those. He's like, think about the location, think about the physical condition of the asset, look at the oak trees, look at what's happening around you. Like there's some stuff that you can't underwrite to, but you just inherently know, and you walk in like, oh man, this has a really good feel, or you know what, that the way this thing's tucked back off the street, I don't like it. You can't account for that in your spreadsheet.
So I speak about that all the time. I tell people, you can buy any deal you want with a spreadsheet. You might be right, you might be wrong, and that works. It works, but the deal can make all the sense in the world on a spreadsheet, and you get there, you're looking over your shoulder because you don't know what's behind you. I don't care if it's showing a 30 or 20 or whatever that number is. I actually posted in our Facebook group today a message, and I scheduled it to go out at 2:30. But it was talking about over the last 2 weeks, I've been having people call me saying, what cap rates do you buy? I'm like, I buy fucking deals that make money. I don't care what the cap rate is because it's an irrelevant conversation when you bring debt involved. And is the deal going to make money or not? And why do people ask that question? It's like, okay, all that means to me is if I say I want a 20 cap, you're going to think I'm crazy. And if you say I want a 4 cap, your property's overpriced. So it doesn't matter, but there's a level, like you said, the art and the science, there's a level of going to a property, feeling and touching it, and the numbers don't always tell the picture. And I think that's a level of real estate that if you don't have, you got to go tour more deals and get it. Cause that's going to, distinguish, that will, you got there and you got that feeling, oh my God, I love this. You can look past some of the, it doesn't pencil out at a 4 cap or whatever the hell that is, but there's a level of that you need to buy real estate. Whatever you're buying, you have to feel it in my opinion.
Yep.
Yeah. I think it's really important. I think it's something that takes a lot of time, and I'm sure Andrew being local, it helps you significantly because you can spend way more time at different times of the day going and looking at properties for sale or properties that just sold or different comps. I know one of the things that I like to do that I think is important is any deal we're looking at buying, stay over and then go drive the property at night because you'll get a really good picture of, what goes on.
Yep.
And that's not always easy to do because you've got different schedules or you've got places to be. But if you live in the city or within a couple hours, that's easy. Maybe you can't do it this week, but I can do it next week. So I think that's probably a huge advantage that you guys get over somebody like us, even though our managers will do a lot of that stuff for us, but you're probably able to get a feel for properties and areas even as they kind of develop and shift and change over months and years, probably better than someone out of state. Is that something you guys do a lot? Like you're just constantly driving by properties and seeing them?
We do. I think we try to make sure we tour everything that's out there just to get to know deals, kind of build your mental database and your real database. Like here's this deal, here's what I traded for, but just seeing it and then driving markets, driving submarkets. Every time we're out doing a tour, what's going on with this latest construction site? Where's the kind of tracking the news and the business journals, which is obviously stuff you can do remotely, but just kind of being out in it. I mean, I think the only disadvantage of being local is sometimes you get caught up in the curse of, there's no way that pocket's worth that much money. I remember when it was this and now it's something completely different. Mm-hmm. Whereas, coming in from the outside, you don't rely as much on what you used to know about an area. But no, we do spend a lot of time in markets and, driving assets and comps and tours just to keep a beat on what's happening.
That happens to us too, though. I mean, there's pockets in markets that we know, and we're just like, how the hell are things trading for that price now? Yeah. It's because, if you've been in a market long enough, you're going to see it, especially the last 10 years, you're going to see it evolve to a certain standpoint. Our manager in Jacksonville, she's born and raised there, 30 years she's been in the business or 20 years she's been in the business. And she tells us stories about things we're buying for, 50, 60, 70, 80 a door. And she's like, I remember when that sold for 10 a door or 15 a door. And I'm just like, that's insane. So, I see the same thing from like 45 to 60 a door. And I'm like, that's crazy. That's never going to happen. Or, 70 to 80. And she's talking about going from, 10 to 70. The longer you're in an area, the more it's going to change. And it's a delicate balance between, staying up with, hey, this is the market, this is where it is, and, understanding what the true value of that area is and not getting carried away with other people coming in and not having as good of an understanding, because there's stuff that does sell for, more than market at the time. And you have to be able to discern whether that's truly, a representation of where this area is, or is it something that, hey, somebody got sold and, I don't really think it's a good representation. And it's not always easy to figure that out. So
you also don't know the business plan of your competitor who bought the deal, and kind of what do they got planned, how much capital they set aside, are they about to tear the thing down, are they about to go put 15 grand a door into it? Like you just don't know. But I think that's part of the fun part, and why the reason you got to stay out in the market. Remember how that deal changed, where they've done this and that to it, and now they're driving the rents, and it's kind of turning the corner on making this whole submarket better. So it's just a part of, it's evolving. I mean, real estate's not static. I think that's part of the fun part. It's always changing, whether it's value add deals or you got the new construction stuff coming in. It's not just standing still.
100%. Couldn't agree more. I think that's an awesome place to wrap up. I think this was awesome. I think this was a ton of fun. Andrew, I think you gave us a ton of really good insights, some good experiences, a ton of great knowledge. If anybody wants to get in touch with you, learn more about you, follow along, learn about the company, where can they do all that stuff?
Yeah, I mean, pretty easy. Wildhorn Capital. We're on all the social media platforms, but our website is wildhorncap.com. My email is andrew@wildhorncap.com, and happy to have a conversation. Love talking real estate. So we're pretty easy to find.
Beautiful. Love it. Thank you so much for coming on. And guys, thank you so much for listening to this episode. If you're not already subscribed to the podcast, it would mean the world to John and I if you would. And if you are subscribed, it would also be great if you would send it to a family member, a friend, or a colleague that you think would get a tremendous amount of value from it. We've also just launched a Facebook group that I think you guys would really like. It's no content. It's all community driven, conversation driven. You can find that by going to Facebook and searching the Real Estate Investing Experience. Andrew, once again, thanks so much for coming on, bud. This was great.
Thanks, guys. I had a ton of fun.
Awesome.